A stock market on the other side of the world just lost a third of its value in 6 weeks. You probably didn't hear about it. Your feed was too busy celebrating record earnings from Amazon, Apple, Meta, and Microsoft. That celebration isn't wrong, exactly. It's incomplete. While one story was playing on your screen, a second one was unfolding underneath it. 5 separate warning lights had already started blinking. Once you see them, you won't be able to unsee them. Start with the one nobody wants to say out loud. Some of the biggest AI companies on Earth are paying each other with money that never really leaves the building. Here's how it works. Nvidia commits up to $100 billion into OpenAI. OpenAI uses that money to build data centers. Those data centers get filled with Nvidia chips. Nvidia ends up guaranteed as the supplier for the very expansion it just funded. Oracle has a similar arrangement with OpenAI. Microsoft has its own version too. Defenders call this a flywheel, supply and demand moving in sync to meet an AI boom that's genuinely real. Critics call it something else. A circle. Money moving from one balance sheet to another and back again, creating the appearance of massive independent demand, when a lot of it is really the same small group of companies buying from themselves. Is that dangerous? Not automatically, but it becomes dangerous the moment the music stops, because a circular deal only holds up as long as every company in the loop keeps growing. Break one link, and the ones next to it feel it immediately. That's warning sign number 1. Here's the second. Companies are now spending more on AI, relative to their revenue, than at almost any point analysts have measured. Big Tech is on track to spend around $650 billion on AI in 2026 alone. Bank of America surveyed 162 professional fund managers this year. 35% said corporations are over-investing in AI at the highest rate in 20 years of similar surveys. Only 20% thought the spending was appropriate. Read that again. The people whose entire job is judging whether a company is spending wisely are, more than a third of the time, saying no. But numbers on a spreadsheet feel abstract. So look at what actually happened in South Korea. This is warning sign number 3, and it's the one you can watch happen in real time. South Korea's stock market, the Kospi, is deeply tied to semiconductor exports, the physical chips that power the entire AI industry. In June, it hit a record high. By late July, it had fallen more than a third from that peak, wiping out over $2 trillion in value in a single week. Circuit breakers triggered twice. Samsung and SK Hynix, the two companies supplying memory chips to Nvidia, dropped double digits within days of each other. When American markets caught the same fear, the Nasdaq had its worst day in 2 weeks. The Kospi isn't just a foreign headline. It's a stress test the rest of the AI trade hasn't taken yet. Why would a chip market crash if AI demand is supposedly endless? Here's warning sign number 4, and it answers that question. Businesses are spending more on AI than ever, but most of them aren't seeing the payoff. One industry survey found companies plan to spend 1.7% of their revenue on AI this year, more than double what they spent last year. Yet only 60% report getting any measurable value from it at all. That means close to half the companies paying for AI tools are doing it without proof it's working. Some are already backing away quietly. Dell relaunched a laptop line at a major tech conference this year and pulled AI almost entirely out of the marketing, going back to talking about battery life and everyday performance instead. When the company selling the hardware stops leading with the AI pitch, that tells you something about what customers actually respond to. There's one more piece, and it's the quiet one. Warning sign number 5 is about how all of this gets paid for. So far, most AI spending has come out of company earnings, real profits, not borrowed money. That's actually one of the healthier signs in this whole story, and it's part of why this doesn't look exactly like the dot-com crash yet. But that's starting to shift. As capital expenditure keeps climbing into the hundreds of billions, some of the biggest spenders are leaning more on debt to keep building. Debt changes everything. Earnings-funded spending slows down gracefully if growth disappoints. Debt-funded spending doesn't have that option. It has a payment schedule. Put those 5 signs next to each other, and a pattern appears that no single headline shows you on its own. Money moving in circles between a handful of companies. Spending outpacing what even professional investors think is reasonable. A real market on the other side of the world, already cracking under the weight of that same story. Half the businesses paying for AI unable to prove it's working. And the foundation slowly shifting from cash that's already been earned to debt that has to be repaid regardless of what happens next. None of this means the AI boom is fake. Compute demand is real. Some of these companies will absolutely be worth what the market says they're worth, maybe more. But a boom and a bubble can share the exact same headlines right up until the moment they don't. So here's what to actually watch, sitting wherever you're watching this from. Not whether AI is real. It is. Watch whether the companies funding each other's growth keep needing each other to keep growing. Watch whether debt keeps climbing faster than earnings. And watch what happens the next time a market somewhere in the world drops 15% in a week, because it already happened once this year, and almost nobody noticed. A stock market on the other side of the world already lost a third of its value in 6 weeks. The only question left is whether you'll notice the next one before your portfolio does.